Somewhere in a filing cabinet, or more likely, on a server farm you'll never see, there's a document with your name on it. It says who really owns your mortgage. And I want you to sit with this for a second. It's probably not your bank. Not the bank whose logo is on your monthly statement. Not the bank whose customer service line you call when you're 2 days late on a payment. Not the bank whose branch you walked into to sign the closing papers. Somewhere between the day you signed your loan and today, your mortgage was very likely sold, then bundled, then sliced into pieces, then sold again, sometimes dozens of times, to pension funds, insurance companies, hedge funds, and investors on the other side of the planet, who have never heard your name and never will. This is the hidden architecture of the modern mortgage. It's called securitization, and understanding it will change the way you look at that monthly bill forever. Let's start with the story you were probably told. You want to buy a house? You go to a bank or a mortgage lender. They evaluate your income, your credit, your down payment. They approve you. They hand over the money. And now, in your mind, you owe that bank, that specific building, that specific institution for the next 15 or 30 years. That mental model made sense in 1965. It barely makes sense today. Here's what actually happens in most cases. The company that originates your loan, meaning the one that funds it at closing, is frequently not in the business of holding 30-year loans on its own books at all. Holding a loan for 3 decades ties up an enormous amount of capital and exposes the lender to interest rate risk, default risk, and regulatory capital requirements. So instead, the originator does something that sounds almost too simple to be true. It sells the loan, often within days or weeks of closing. Sometimes the sale is even arranged before your loan officer shakes your hand. Your loan becomes a financial product, and financial products get traded. To understand where your mortgage goes, picture an assembly line, not for cars but for debt. The 6 stations. Station 1, origination. A lender of a bank, a credit union, or a non-bank mortgage company underwrites and funds your loan. This is the only part of the process most homeowners ever see or think about. Station 2, aggregation. The originator sells your loan, along with thousands of other loans to an aggregator. This is often a large financial institution or a government-sponsored enterprise, names you've probably heard, Fannie Mae, Freddie Mac, or Ginnie Mae. These entities exist specifically to buy mortgages from lenders, which frees up the lender's capital to go make more loans. It's a churn machine built on purpose. Station 3, pooling. Here's where things get genuinely strange if you've never encountered this before. Your loan is combined pooled with hundreds or thousands of other mortgages that share similar characteristics. This pool is not a metaphor. It is a legally distinct financial entity, usually something called a trust. Station 4, securitization. The trust that now legally holds this pool of mortgages issues securities, bonds, essentially, that are backed by the cash flow from all of those mortgage payments. These are called mortgage-backed securities, or MBS. When you make your monthly payment, that money doesn't stop at a teller window. It flows up through this entire structure. Station 5, tranching. This is the part that made mortgage-backed securities infamous. The cash flows from the pool of mortgages are sliced into different risk categories called tranches, a French word meaning slice. The safest tranche gets paid first and takes on the least risk of default, so it earns the lowest interest rate. The riskiest tranche gets paid last, absorbs losses first if borrowers default, and in exchange, pays a much higher interest rate to compensate investors for that risk. A single mortgage pool might be sliced into a dozen or more of these tranches, each sold separately to different types of investors. Station 6, distribution. Those tranches are then sold to investors around the world. Pension funds looking for steady income, insurance companies matching long-term liabilities, sovereign wealth funds, hedge funds looking for yield, and yes, sometimes even other banks. By the time this process is finished, your single mortgage has become a tiny thread woven into a financial instrument that might be owned in fragments by dozens of institutional investors, scattered across multiple continents. If dozens of investors technically own fractional interests in your loan, who's actually managing your account, sending your statements, and answering when you call about a late fee, That's the servicer. And this is one of the most misunderstood roles in the entire mortgage industry. A mortgage servicer is a company hired to handle the day-to-day administration, collecting payments, managing escrow accounts for taxes and insurance, sending statements, handling delinquency. Here's the key thing to understand. The servicer usually does not own your loan. They're a contractor, a middleman. Their revenue doesn't come primarily from interest on your mortgage. It comes from servicing fees, typically a small percentage of the outstanding loan balance. This explains something that confuses a lot of homeowners: why your bank seems to change every few years, with zero warning and seemingly no reason. What's actually happening in most of these cases isn't that your loan is being resold in the ownership sense, it's that the servicing rights are being sold. One company decides it's more profitable to offload the administrative burden of servicing loans, and another company buys those rights. You, the borrower, have almost no say in this. Your contract terms don't change. Your interest rate doesn't change. But the entity you make out a check to command does change. Now here's where it gets even more interesting, and this is the part almost nobody outside the mortgage industry knows about. Every time a mortgage changed hands, that transfer was traditionally supposed to be recorded at the local county recorder's office. That's how property records work, a public paper trail intended to let anyone verify who legally holds an interest in a piece of property. But once mortgages started being bought, sold, pulled, and resold at the volume securitization required, recording every single transfer at the county level became a massive administrative bottleneck. So the mortgage industry created a private electronic registry called MERS, the Mortgage Electronic Registration System. Instead of recording every transfer of ownership at the county level, lenders could name MERS as the nominee on the mortgage document, and MERS would track ownership transfers internally, electronically, without each one going through the public county recording process. This system streamlined an enormous industry. It also became legally controversial. During and after the 2008 financial crisis, courts across the country grappled with a genuinely difficult question. If MERS was listed as the nominal party on the mortgage, but the actual ownership had changed hands multiple times through securitization, who actually had the legal standing to foreclose? Some courts ruled that certain foreclosures were improperly conducted because the entity attempting to foreclose couldn't adequately prove it held the right to do so. A problem that came to be known, somewhat infamously, as robo-signing, where paperwork attesting to loan ownership was signed en masse, often without the signers actually verifying the underlying facts. The upshot: the very system built to make mortgage trading efficient also made mortgage ownership, at times, genuinely murky even to courts. It's worth pausing here and asking, why does this entire elaborate system exist in the first place? Is it just complexity for complexity's sake? Not exactly. Securitization was built to solve a real problem. Before this system matured, mortgage lending was constrained by how much money a local bank actually had sitting in deposits. If a bank in a small town made too many 30-year home loans, it could run out of capital to lend to new home buyers, even if demand for housing kept growing. Securitization severs that link. By selling loans off their books, originators recycle their capital and make room to originate more loans. In theory, this expands the pool of available mortgage credit, can lower interest rates for borrowers by tapping into global investment capital, and spreads risk across many investors rather than concentrating it in one institution. That's the pitch, and there's real truth in it. Mortgage securitization is a major reason the 30-year fixed-rate mortgage became widely available at scale in the United States. But 2008 showed the world the other side of this coin. When underwriting standards eroded, when loans were made to borrowers who couldn't realistically repay them, and those loans were pulled and sliced and sold anyway, dressed up with favorable credit ratings, the risk didn't disappear. It just got distributed so widely and so opacally that almost nobody could see how much danger was actually baked into the financial system, until it started collapsing all at once. The tool that spreads risk can also spread problems. That's the double edge of securitization, and it's the reason regulators pay very close attention to it today. So, practically speaking, what should you actually do with this information? First, know how to find out who really holds your loan. In the United States, you're legally entitled to this information. You can request it from your servicer, and federal law generally requires them to tell you. There are also public lookup tools, including ones maintained in connection with Fannie Mae and Freddie Mac, that can tell you whether one of those two entities backs your loan. Second, understand that your servicer and your loan owner may not be the same, and that matters most if you're ever negotiating a loan modification, forbearance, or working through a hardship. The servicer often has to operate within rules set by the actual investors or the trust, which is part of why loan modification processes can feel maddeningly bureaucratic. You're not always negotiating with a decision maker. Sometimes you're negotiating with an agent whose flexibility is limited by a contract you'll never see. Third, don't panic when your servicer changes. It happens constantly, it's legal, and your loan terms are protected regardless of who's collecting the check. But do watch closely during any transition, verify your new servicer promptly, keep records of your payment history independently, and make sure nothing gets lost or miscredited in the handoff. And fourth, more broadly, understand that the mortgage market is genuinely global and genuinely interconnected. Your monthly payment isn't just a local transaction between you and a neighborhood bank. It's one small data point flowing through a vast financial system that connects your kitchen table to trading floors and investment portfolios around the world. Your mortgage payment leaves your account and travels further than you probably ever imagined. Through an originator, into a pool, sliced into tranches, distributed to investors you'll never meet, administered by a servicer who may not be who you think it is, tracked by a private registry most homeowners have never heard of. None of this is a conspiracy. It's a system built with real financial logic, carrying real financial risk, and largely invisible to the person actually living in the house. The next time that statement lands in your inbox, you'll know there's an entire hidden infrastructure behind that one number you're staring at. And now, you understand it better than most people ever will.